All right, team, let's dive into this question. I get it a lot. What's happening a lot right now is they have equity. So they're selling one home, moving up to the next one and going, hey, we've got a couple hundred, 300 grand to put down. Should we put money down on the next home and not buy VA and go conventional instead? Or, hey, we're refinancing. We have all this equity. Should we just refi as a conventional? Do we even need to do a VA refi? What's the difference? So you're going to see right there, Derrick Evans, VA home loan specialist. That's true. I'm a VA home loan specialist, but this will be a breakdown that will be completely and totally unbiased. You'll see that there are reasons, there are milestones. There's no opinion here. There's no opinion on this. This is flat out facts. And you'll see there are times where it may make sense to look at a conventional. There are many cases in which you should go VA. If you're considering one or the other, consider this a good guideline. And I decided to do this old school. Listen, PowerPoints, I usually do PowerPoints. I know people in the military are sick of seeing PowerPoints. So you're only qualified for a VA loan if you've served the country or currently serving the country. So I know you hate PowerPoints. So I'm not doing a PowerPoint. I'm trying to make it a little bit visual using my little whiteboard here. So let's dive in. So first and foremost, down payment. How much do we have as a down payment? That is going to be one of the most crucial elements to understand. Because right here, if you have 20% down or more, okay, so 20% is the number we're going to look at. If you have 20% or more, then we have something to talk about. If you're going to be less than 20%, then you're going to go VA, okay, 100% of the time. If you don't have at least 20% to put down, we're going to go VA, okay? And that's just going to be across the board because you're going to have mortgage insurance. That mortgage insurance is not tax deductible. It is not anything for you. It's for the bank, but you have to pay for it because you're putting down less than 20%. So that is a fee that you do not want to pay, and you don't have to pay with the VA ever. So if you're less than 20%, we're going to use 20% as our number here. That's our main number. You're going to go VA. If you're going to put down 20% or more, that's a greater than or equal to right there, then you can take a look at possibly doing a conventional, okay? It may or may not still make sense to do a conventional because now all you've done is level the playing field with regard to there being no mortgage insurance. That's the playing field that's been leveled. But typically, the conventional loan is going to have an interest rate that's about 0.25% higher than a VA. Okay, so about 0.25% higher. It could be more. It could be 0.5%. Depends on your credit score. This one is also the conventional loan is also much more credit score sensitive. So it's very sensitive to that 3-digit number that you have, which if it's a 719, that's going to be bad for you if you're getting a conventional loan, but it'd be totally fine if you're getting a VA loan. If you're in the 600s or something like that, you're definitely going to want to go VA. So you kind of have to look at credit as well as down payment on this line right here to really decide. But the main thing that I want to get across is that if you're putting less than 20% down, you're going to go VA. Okay. If you're putting more than 20%, now we need to inquire further. Now we need to see, okay, we're putting down 20% on this loan. What's the rate VA? What's the rate conventional? So we can do some apples to apples. You're still most likely going to find that the VA will be better, but it will especially be better if you have lower credit scores. When I say lower credit scores these days, that means anything under 720. I remember when people used to say, I got 700 credit, and that was like a great credit score. We now know the median credit score in the country is 686. So 700 is not that great from a risk management standpoint on the lending side. And people now want 800 credit instead of 700 credit. So that's kind of how that's going. All right. The next one. All right. Funding fee. That's what FF is. Do you have to pay a funding fee? If you have a disability rating, then you're going to pay $0. You're not going to pay a funding fee. So if you have a disability rating with the VA, then it's going to always make sense to go VA. If you do have a disability rating, okay, and you're putting down 20%, then as of today, your VA funding fee is going to be 1.4%. So it's going to be 1.4% of your total loan amount. And that is going to be a fee that gets added onto your loan. So it's not out of pocket, but it gets added onto your loan. So how do you sort of level the playing field? So, hey, we have to pay a funding fee. We're putting 20% down, but we do have to pay a funding fee. We don't have the disability rating. So now we're looking at this number here. It's 1.4% that we've got to add on to our loan. And how do we apples to apples that? Well, what you do is you simply look at the conventional buy down. This is also called points But points can mean origination points. It can also mean discount points. But you go ahead and you look and you see, okay, well, what would happen if I pay an equivalent amount in points? So this is my VA fee over here. So what if I paid 1.4 points over here? What would that rate be? And now you can compare them apples to apples and see which is going to be the best deal, because your rate over here with the VA might be 2.5. Your rate on the conventional might be 3%. But once you pay the points, it may make them the same. And if they're the same, I'm going to tell you right now, if they're really close to being the same, in other words, if it's within a few dollars of being the same loan, VA or conventional, go conventional. I know the VA guy's telling you to go conventional only because, here's the reason. Go conventional because you can save that VA bullet in your magazine, in your gun, in your holster, and you can shoot it later. You go conventional anytime and as many times as you want, but the VA is different. There's limitations to it as far as how many times you can use it and what the benefits are each time you use it. So if you can save the VA and go conventional and get similar terms, really close to the same terms as with the VA, go ahead and go conventional. Go ahead and go conventional. But most of the time, what you're going to find if you decide to pay this 1.4% in points on the conventional is the VA will still be a better deal most of the time. If it gets close, though, go ahead and go conventional. So the funding fee is one thing. Remember, if you don't pay a funding fee, you're going to go VA, 100%. If you do pay a funding fee, which if you're putting 20% down, it's going to be 1.4% as of today, then look at paying that in points in the conventional loan so that you can apples to apples compare the VA and the conventional. If it's close, go conventional. Go conventional if it's close. Save your VA for a rainy day. Now, the other thing to consider, these are the two main things, okay? Down payment, funding fee, and then, of course, credit score does factor into this, but that's something that you have to just kind of go through the process. What are your plans? What are your plans? If you're buying, you have money down. So remember, this is all, every question that I'm answering here, everything I'm discussing is based on the idea that you have 20% down. Because if you don't have 20% down, what do we decide? We figured this out earlier. You go VA. If you do have 20% down, what kind of plans do you have for this house? Is this a house that is this your forever home? Is this your retirement home? Is this just one of many homes you plan to buy in your life? That can factor in. If this is your forever home, you have no plans to buy any other real estate, you have no plans to move anywhere else, go VA. If this is one of many homes that you plan to purchase in your lifetime, or one of many homes you plan to purchase, one every duty station or whatever it may be, and you want to keep that VA available for later, you don't want to have to do a refi later when, who knows, rates could be higher later. Or, something else, maybe values are down, or something else makes it more difficult for you to refi. So if you can avoid doing a refinance later by doing the conventional now, then do that. Go ahead and go conventional. So we need to have the 20% down. That's crucial. Let me just go ahead and circle that. This is what everything basically tips off of this. Because if we're less than 20% down, we're going VA. All right, all day, every time. If we have the 20% down, I'm going to recap everything here real quick. If we have the 20% down, then we go to the next line to decide. Now, 20% down means we could very well go conventional, but we have more questions to answer. Do we have a disability rating? Okay, if we have a disability rating and therefore we're paying a zero funding fee, then you're also going to go VA. Okay, so if you have a disability rating, you're always going VA. If you have less than 20% down, you're always going VA. If the VA and conventional loan options are similar, so let's say you pay a VA funding fee here, 1.4% with 20% down as of today, you need to see how much that would help your rate if you paid that in points over here, and then compare the two. And that will help you decide. If it's close, which way do we go? Conventional. That's right. If it's close, if the two loan options are close or similar, go conventional, save the VA. And then based on your plans, if this is one of many homes and things are similar, go conventional. If this is your forever home, you just want the best loan. You want one that's simple, assumable. One of the great things about the VA loan, and why I say if it's your forever home, definitely use the VA, it's an assumable loan. So your heirs can assume the loan. They don't need to get a new loan. They don't need to refinance. They can assume the loan into their name with your rate, your terms, your remaining balance, nothing changing at all. It's very easy. It's a couple pages. Simple thing to do. So it's a great legacy loan as well, especially if you get, a great rate today, and 10 years from now, rates are much higher. That would be something that would be very beneficial to your heirs. So for the most part, if you're, forever home, you're going to go VA. If you plan to buy more and the loan terms are similar, go conventional. And that is how you can figure this out. Now, we talked earlier just briefly about, hey, a credit score really impacts this. So if I am putting 20% down, but I have a 642 credit score, then you're going to pretty much guaranteed be better off going to VA. Conventional needs a much higher credit score to make sense. So, that's one thing that will also hinder you a little bit. I'll go ahead and say if your credit score is in the 600s, let's just put this in writing. If you're in the 600s, pretty much anywhere, no matter what, you're going to go VA. So that's a brief breakdown of a couple of the important key metrics. If you want to get more granular with this, if you want to look more specifically, I can create a full breakdown for you for your particular scenario on this. All you have to do is call, text, my number's on the screen, shoot me an email, whatever's easiest for you, and I'm happy to do the math and make sure you know exactly what option is going to be best for you based on your goals and your family. All right, that's it for today. Subscribe to the channel. If you want to get more videos like this, call, text. If you want to buy or refi, I'm happy to help. Talk to y'all soon.